Welcome to today's comprehensive guide on investing in dividend stocks for beginners. If you're looking to build passive income and create a sustainable investment portfolio, you're in the right place. Dividend investing has been a proven strategy for over a century, offering a reliable income stream while allowing you to grow your wealth over time. In this guide, I'll break down everything you need to know, from understanding what dividends are, to picking the best stocks, to creating a diversified portfolio. By the end of this video, you'll have a clear blueprint for starting your dividend investing journey. Let's start with the basics. What exactly are dividends? Dividends are regular payments that companies make to their shareholders. When a company generates profits, it can reinvest them back into the business, pay down debt, or distribute a portion to its investors. When they choose the latter, those payments come in the form of dividends. For example, let's say you own 1,000 shares of Company A, and they pay a quarterly dividend of $0.50 per share. Every 3 months, you'll receive $500 directly into your brokerage account, simply for holding the stock. That's $2,000 annually, without having to lift a finger. Now, here's why dividends are so powerful. They are a form of passive income, and over time, they compound. If you reinvest your dividends to buy more shares, those shares will, in turn, generate even more dividends. This snowball effect is how many investors create substantial wealth. Dividend investing has been a cornerstone of financial planning for decades, and there are good reasons for its popularity: stability during market downturns. Unlike speculative investments, dividend-paying stocks tend to be more stable during economic downturns. Companies like Johnson & Johnson and Procter & Gamble have paid dividends consistently for decades, even during recessions or stock market crashes. Reliable income stream. Dividends provide a steady source of income, which can be reinvested or used for living expenses. For retirees, dividend income can supplement pensions or Social Security. Inflation hedge. Over time, dividend-paying stocks generally appreciate in value, offering protection against inflation. In addition, many companies grow their dividends annually, further enhancing your purchasing power. How dividend investing compares to other strategies. To understand why dividend investing works, let's compare it to other popular investment options. Suppose you have $10,000 to invest. Savings account, you might earn around 0.5% annually. That's $50 a year, not even enough to keep up with inflation. Growth stocks. These stocks, like Tesla or Amazon, aim for capital appreciation but don't pay dividends. While they may offer high returns, they're speculative and can be volatile. Dividend stocks. If you invest in a stock with a 3% dividend yield, you'll earn $300 annually, plus any capital appreciation. And during downturns, you still collect dividends, cushioning your losses. Over 20 years, reinvesting dividends can result in significantly higher returns than relying solely on growth stocks. That's the power of compounding dividends. How dividend investing works. An example. Let's walk through a detailed example. Imagine you invest $30,000 in PepsiCo, a well-known dividend stock with a yield of 3%. Every year, you'll earn $900 in dividends. If PepsiCo raises its dividend by an average of 5% annually, a common practice among established companies, that $900 could grow to over $1,500 annually in 10 years. Now, let's add the effect of reinvesting dividends. By purchasing more shares each quarter with your dividend income, your position grows faster, which means your future dividends are based on a larger shareholding. Over 20 years, this reinvestment strategy could turn your $30,000 into nearly $100,000, assuming a modest growth rate. Choosing the best dividend stocks. Not all dividend stocks are created equal. Here's how to identify the best ones for your portfolio. Dividend yield. The dividend yield is the annual payout divided by the stock price. While high yields above 5% might seem attractive, they can signal financial instability. Look for yields in the 2% to 4% range, as these are typically more sustainable. Example: Coca-Cola offers a stable 3% yield, backed by decades of consistent growth. Dividend growth history. Focus on companies that increase their dividends regularly. These are often referred to as dividend aristocrats, companies that have raised dividends for 25+ years, or dividend kings, 50+ years. Examples include 3M and Procter & Gamble. Payout ratio. This metric shows the percentage of earnings paid out as dividends. A lower ratio, under 60%, suggests the company retains enough earnings for growth and has room to maintain or increase dividends. Free cash flow. Ensure the company generates sufficient cash flow to cover its dividends. Avoid companies with declining cash flow or excessive debt. Sector diversification. Build a portfolio that spans multiple industries. For example, consumer staples, Procter & Gamble, PepsiCo, technology, Microsoft, Apple, healthcare, Johnson & Johnson, Pfizer, utilities, Duke Energy, NextEra Energy. Diversification minimizes risk and ensures your income stream isn't overly dependent on a single sector. Building your portfolio. Once you've identified your target stocks, it's time to build your portfolio. Here's a step-by-step guide. Start small. Begin with 1 or 2 companies you believe in and gradually add more as your confidence grows. Automate investments. Most brokerages offer dividend reinvestment plans, DRPs, which automatically reinvest your dividends into additional shares. This automation accelerates compounding. Monitor your holdings. While dividend investing is a long-term strategy, keep an eye on your portfolio to ensure the companies remain financially healthy. If a company cuts its dividend, investigate why. It could signal trouble. Real-life scenario. The power of patience. Let's look at a real-life scenario to illustrate the power of dividend investing. In 1980, an investor named Ronald Reed, a gas station attendant, began buying dividend-paying stocks like AT&T and ExxonMobil. By the time he passed away in 2014, his modest investments had grown into an $8 million portfolio. How? He consistently reinvested dividends and let time work its magic. This story highlights 2 key points. You don't need a high salary to build wealth, just discipline and a sound strategy. Dividend investing rewards patience and consistency. Advanced strategies, options, and covered calls. For those ready to take dividend investing to the next level, consider incorporating option strategies, selling covered calls. If you own 100 shares of a dividend stock, you can sell call options to generate additional income. This works well if you believe the stock price will remain stable. Cash-secured puts. Sell put options to buy more shares at a lower price while earning income from the premium. This is a great way to accumulate shares of quality dividend stocks. These strategies require a deeper understanding of the stock market, so proceed with caution or consult a financial advisor. Taking your dividend investing to the next level. Understanding taxation and dividend income. One of the most common questions for beginners is, how are dividends taxed? This is a critical factor to consider because it can significantly impact your net returns. Dividends are classified into 2 categories. Qualified dividends. These are taxed at the lower capital gains tax rate. To qualify, you must hold the stock for more than 60 days during the 121-day period around the ex-dividend date. For most U.S. taxpayers, this means a tax rate of 0%, 15%, or 20%, depending on your income bracket. Ordinary dividends. These are taxed at your regular income tax rate, which can be as high as 37% for high earners. Most REITs, real estate investment trusts, and some high-yield stocks fall into this category. For tax-advantaged accounts, like Roth IRAs or 401ks, the story is different. Dividends earned in these accounts are either tax-deferred or tax-free, depending on the account type. This makes them an ideal vehicle for dividend investing, especially if you're planning to reinvest your dividends. Reinvestment strategies and compounding growth. Dividend investing thrives on the concept of compound growth. When you reinvest your dividends, you're effectively buying more shares, which in turn generate even more dividends. This creates a virtuous cycle of increasing returns. For instance, consider Company B, which pays a 3% annual dividend and appreciates in value by 5% each year. If you start with a $10,000 investment and reinvest all dividends, your portfolio could grow to over $20,000 in 10 years, even without adding new capital. In 20 years, that same portfolio might exceed $50,000. The Dividend Reinvestment Plan, DRIP, automates this process. By enrolling in DRIP through your brokerage, dividends are automatically used to purchase additional shares. This eliminates the temptation to spend the cash and ensures that your portfolio grows steadily over time. Diversification in dividend investing. One of the golden rules of investing is diversification. Never put all your eggs in one basket. Even in the world of dividend stocks, spreading your investments across multiple sectors and industries is vital to mitigating risk. Example portfolio for beginners: consumer staples. Examples: Coca-Cola, Procter & Gamble. Why? These companies produce essential goods, making them resilient in economic downturns. Technology. Examples: Microsoft, MSFT, Apple, AAPL. Why? Established tech companies offer growth potential while paying steady dividends. Healthcare. Examples: Johnson & Johnson, Pfizer. Why? The healthcare sector benefits from consistent demand and innovation. Utilities. Examples: Duke Energy, Nextera Energy. Why? Utilities are stable, regulated businesses with predictable cash flows. REITs, real estate investment trusts. Examples: Realty Income, Simon Property Group. Why? REITs offer exposure to real estate and typically have higher than average dividend yields. This diversification ensures that if one sector underperforms, the others can balance out your returns. How to identify dividend growers. Dividend growth is a key factor in long-term success. Companies that consistently raise their dividends, known as dividend growers, are often financially stable and committed to rewarding shareholders. These stocks are the backbone of a robust dividend portfolio. Metrics to watch. Look for companies with a 5 to 10% annual dividend growth rate. A rising dividend often signals a healthy, growing business. Payout ratio. A lower payout ratio, under 60%, is preferable as it indicates the company has room to maintain or increase its dividend during tough times. Free cash flow. Free cash flow is the lifeblood of dividend payments. Ensure the company generates enough cash to sustain payouts. Case study: Dividend Aristocrats and Kings. Dividend aristocrats, companies that have raised dividends for 25+ consecutive years. Examples include 3M and McDonald's. Dividend kings, companies with 50+ years of consecutive dividend growth, such as Coca-Cola and Parker Hannifin. By prioritizing dividend growers, you're building a portfolio that's resilient in both bull and bear markets. Why start dividend investing today? The best time to start investing was yesterday. The second best time is today. By starting your dividend investing journey now, you're setting the foundation for a future of financial independence. Whether your goal is to supplement your retirement income, build wealth for your family, or simply enjoy a steady stream of passive income, dividend stocks are a reliable and rewarding choice. Final thoughts. Dividend investing is more than just a strategy. It's a mindset. It's about valuing steady, reliable growth over speculative risk. By carefully selecting strong companies, diversifying your portfolio, and reinvesting your dividends, you can build a financial future that works for you. If you found this guide helpful, please like the video, subscribe for more investing tips, and let me know in the comments. Which dividend stock are you excited to buy? Thanks for watching, and I'll see you in the next video.